Let's talk about VT and VTI, two ETFs by Vanguard that have very similar ticker symbols and no doubt confuse a lot of people, but they are two very different funds. We'll start with VT, Vanguard's Total World Stock ETF. Now that total world means that it has both US stocks and international stocks in the fund. And it's got an expense ratio of 0.08%, otherwise expressed as 8 bips or 8 basis points. Most commonly, 8 bips. With Vanguard, you really never have to worry about a high expense ratio. They are genuinely an investor-focused firm, and I think that is their slogan. VTI is Vanguard's total stock market ETF. I think it would be a lot more clear if they stuck the letters US in right here so it read Vanguard Total US Stock Market ETF. As that name implies, or as the description of the name implies that I'm giving you, it only holds US stocks and it's got an expense ratio of 3 bips. So, a hair cheaper, but in the big picture, that's really not a material number there. So let's take a look at their holdings, and we'll start by going back to VT. We can click on portfolio here. And when it loads, we will see asset allocation. There's asset allocation, and we can see that VT, Vanguard's Total World Stock ETF, is holding about 59% in US equity and 40% in non-US international equity. I find that pretty interesting, and what I have to point out here and why I find that interesting is this is pretty damn close to a market cap split globally. Right? This is about where the global market cap works out, 59% US, 40% non-US, as of recording this in January 2022. Whereas a lot of funds that hold both foreign, international stocks and US stocks, they tend to have a tilt, at this time, they have a tilt towards US stocks. We'll talk about why that is, but funds that are coming to mind are like iShares line of asset allocation funds, AOA. I know that they hold about 70% or so of their equity exposure in US stocks. And then also Vanguard's Life Strategy line of mutual funds, they tend to tilt towards US equities. Whereas this one, VT, Vanguard's Total World Stock ETF, is staying pretty damn close to the actual market cap weightings of US equity and non-US equity. I find that really interesting. We'll come back to that in a few minutes. Vanguard's Total Stock Market ETF, VTI, if we click on portfolio and look at the asset allocation on that one, I'm expecting it to show about 100% in US equity, and it does. Now, if we look at the stock style chart on this, we can see, a large blend ETF, which would be like, well, basically the S&P 500, doesn't get much exposure to mid cap and basically no exposure to small cap, whereas Vanguard's Total Stock Market ETF does. Now, if we look at this in context of the world, we can see, that if we see global market large cap on here as the kind of reddish maroon line, and then the Total World Stock ETF does get more exposure to smaller companies, but the chart isn't exactly going down into the small cap. And I'm guessing this is probably because there are just so many freaking companies. And if we come down to, where is it? Equity holdings, there's 9,304 stocks in this Vanguard Total World Stock ETF, right? So they can't really capture the global market cap of small caps. They can't really get all the small cap stocks into one fund. It's just impractical. But fundamentally, it's not going to make any difference on the returns, broadly speaking. Yeah, technically there could be some differences, but it's really not going to be that material. It's not going to be a material difference. So you get exposure to 9,300 holdings here. Now, if we look at the holdings, right, when you come back to VTI, you can see Apple 5.71, Microsoft 5.21. It's just so wild that the two largest companies in the United States make up almost 11% of the stock market. Then Amazon, Alphabet, Tesla. And if we look at the world stock, it's probably going to be pretty close to the same in the top holdings, but a smaller weighting, that is to make room for the international stocks. So where do we get our first international stock? These are looking all pretty standard, right? Pretty standard US stocks in the top 10. Here we go. Taiwan Semiconductor is going to be the first holding that is non-US equity. And then Nestle, and then Tencent. That'll be 3 of them in the top 20. So yeah, those are the companies that you get exposure to. And you're getting exposure to international markets. Let's just take a look at the actual sector exposure. What is the global sector exposure? What is the top three? Technology at 21.45, financial services 14.99, we'll call it 50, and then consumer cyclical at 11.9. Now, I think if we look at the US, you're going to get much more exposure to tech, probably going to be like 30%. And where is it here? Technology 26.6, and then healthcare 13.4, and then financial services at 12.89. So healthcare in the global, in the global sphere isn't quite as large. So when you're going global, you're getting more exposure to different sectors, and they're going to be sectors that haven't been performing as well. Because as we're about to see here, we might as well jump on this topic now. Foreign stocks, international stocks, they have not been performing as well for the last few years. So let's just look at that. We'll come back here. We'll pull up the interactive chart. We'll put VTI on there, so we have VTI and VT. We'll hit it for maximum. And there we go. We can see VTI being the total US market just rip-roaring above the global stock market. So the difference between it over this period in time, which is about 13 years, going back to June 30th, 2008, $10,000 would have grown in the U.S. stock market 343% to a total value of $44,300, and in the global stock market portfolio, your $10,000 investment would have grown 172%, so only about half as much to a total value of $27,221. So, I mean, when you look at this, you can just see the U.S. is rip-roaring. U.S. equities have been on a rip-roar bull market basically since the financial crisis. So, this outperformance here by U.S. stocks is why a lot of fund managers and fund issuers, etc., like AOA and VASGX, have kind of been letting the funds tilt towards U.S. stocks because they just keep rip-roaring up. Now we can look back a little bit longer because this chart is limited by the time that VT has been in existence since June 30th, 08. We can look back a little bit longer if we go into Portfolio Visualizer here, and I was able to just use global equities and US equities here to represent it. And we can see it going back to 1986 with the blue line being the global portfolio and the red line being US equities, right? So we can see in the late 80s to early 90s, the global portfolio with international exposure did outperform a little bit, but since then, it has just basically been, the US outperforming. In the 2000s, international stocks had a pretty good market there. And then going forward here in the last, say, 12 years or so, US stocks outperforming. So when you're looking at this, you're kind of like, why do I need international equity exposure? And somebody in the blogosphere online called it deworsification. They said that getting exposure to international stocks is basically a deworsification because the US stock market outperforms. And I gotta say, that is wrong. Let's take a look at some charts here that I pulled up. I found this chart right here, initially published on IFA, republished on Optimized Portfolio, and now being used here in this YouTube video, and will also probably get published on my website. We can see the performance, or which asset class, global equities or US equities outperformed decade by decade. And this is represented by the MSCI World Index, excluding the USA Index, right? That's orange. I don't even know what color you'd call this here. Gray-blue color is the S&P 500. So we can see in the 70s, international stocks outperformed US stocks by a long shot. In the 80s, international stocks outperformed a little bit. In the 90s, US stocks basically had that big rip roar up. And then in the 2000s, International stocks kind of had their heyday. Granted, it was not a pretty decade for any asset class there. And then in the 2010s through then to 2019, beginning of 2020, S&P 500 just absolutely kicking ass over global equities. So what I want to point out is that in these charts, like this one and this one, it's hard to see the difference between global equities and US equities in performance. It just seems like US equities are outperforming all the time. But when we start breaking the data down, we can see that that is not always the case. You really don't know which one is going to outperform. And there is some data, and kind of analysis out there that kind of says, hey, US equities have had this rip-roaring bull market. They are statistically unlikely to outperform or continue to outperform international equities going forward in the future. So that's one thing to consider when you hear these terms thrown around like deworsification and people saying that having exposure to international equities is deworsification. You have to keep that stuff in mind. Let's look at a couple other charts here. This chart that I found, source being Bloomberg, now published on economicpickdata.blogspot. There's actually some pretty good information on this site. Shows the CAPE ratio, the cyclically adjusted price to earnings ratio, which is a price to earnings ratio adjusted for inflation of the global stock market index, excluding US. So basically the same index as what was looking at here. Is that the same index? Yeah, I think it's exactly the same index. You can see the CAPE ratio of the global stocks here against the S&P 500 CAPE ratio. And you can see the extreme difference. And this is the valuations. The valuations of US stocks are incredibly high relative to global stocks. So you can buy with your dollar, you can get more earnings in a global stock market than you can in the US stock market. There's been some data out there by Rob Arnott and AQR, some research by Rob Arnott and AQR that finds a correlation between the CAPE ratio and I think forward 5-year returns or something, basically saying, hey, whatever one is lowest, and when they start getting very wide like they are now, and the difference between CAPE ratio is incredibly high. I mean, the US has more than, is that more than double? It's about double. The US has a CAPE ratio about double, so double the valuation of international equities. When they start getting in far spreads like this, the performance of the underperformer going forward is substantial. So, basically it's like mean reversion. And then finally, what else do I got here pulled up? This one here from Morningstar shows the international view versus US stocks 5-year rolling return gaps, okay? All right, so this one is a little confusing to explain and digest, but when we look at it here, if it's up here on this side of things, it means that international stocks outperformed US stocks over a rolling 5-year period by a difference of this, whereas US stocks down here, this means that US outperformed international stocks by a difference of, well, from here to 0. So you can see the periods here where international stocks are outperforming in the 70s. And then there's that outperformance period in the late 80s to early 90s. Then down here, 90s, international stocks kind of sucked in the 90s. US stocks rip-roared up into the dot-com bubble. And then in the 2000s, international stocks came back into the spotlight. And then from 2010 onward, it has just basically been a US smoke show. So yeah, all of these charts and all of this data is basically to show that you should have, or I think in my opinion, you should have some exposure to international equities because you really don't know, which one is going to outperform. There's really no predictive analysis behind it, and there's really no way of guessing which one is going to outperform and which one is going to outperform when. So therefore, I think it's important that you have exposure to international equities. And that said, looking at some of the data and considering the bull market of US equities, it does seem like, sometime soon, international equities are going to come back into the spotlight and have their moment. But that said, we really don't know how long. So therefore, the best thing to do is to have a broad market exposure to international equities. So anyways, Back to the topic here of VT and VTI. I think I've stressed it enough that VT is holding the total world stock at about a market cap weighting, whereas VTI is just US. So which one should you have in your portfolio? Let's address that. Well, VT is going to be for somebody that really wants to have a very simple portfolio, like a 2 or 3 fund portfolio. I know a lot of people talk about the 3 fund portfolio. Well, really with VT, you could do a 2 fund portfolio. You could use VT to get your exposure to equities, and then you could use a total bond market ETF, which I don't know the ticker symbol, but I think the total bond market mutual fund by Vanguard is VBMFX. There you go. You could just do that and have a 2 fund portfolio. VTI you would want to use if you're doing a 3 fund portfolio and you want to control your allocation to international equities and US equities. That would be, primarily, I think, where you would want to hold VTI, or the scenario that you'd be in that you'd want to hold VTI. So that way you can control between US and international equities. Or if you're going to, maybe break your portfolio up into more of a complex portfolio and have, say, 7 to 10 holdings, then maybe, you could fit VTI in there. But in the video I did with VTI and VOO, which is VOO is the S&P 500 mutual or ETF by Vanguard, I did mention that if you want to really break up your portfolio, then you're probably going to want to have exposure to large cap, small cap, right? So in that case, you'd want to use VOO and then whatever Vanguard's small cap ETF is. I think it's VBR, VBK. So yeah, keep that stuff in mind. If you're looking to go simple on your portfolio, VT is going to be the one for you. If you want to really focus on and control your split between international equities and US equities, VTI is probably more your ticket. So what do you guys think about VT and VTI? How are you fitting them into your portfolio? Let me know in the comments below.